Good morning, everyone. I'm Chris Sandlin, GeoPhy's Director of Product Marketing. Welcome to our Tenant Financial Health webcast with GeoPhy's Chief Economist, Niels Koch. In addition to his work at GeoPhy, Niels has been a professor of real estate finance at Maastricht University in the Netherlands for almost 15 years. In a moment, Niels will be providing our inaugural update on the financial health of tenants in U.S. multifamily properties, ranking the top and bottom metro areas through Q4 2020. Going forward, Niels will be hosting this webcast quarterly on the second week after quarter end. So please look forward to our next webcast on the week of April 12th. Niels's presentation will last about 30 minutes, after which we'll have time for Q&A. We've muted all microphones except for the speakers. If you'd like to ask a question, please post it to Q&A and I'll raise it with Niels. And finally, we'll be providing an archive of this webcast. Please look for an email notification after we finish and pass it along to any colleagues who would find it beneficial. And now, take it away, Niels.
Well, thank you, Chris, and thank you for putting up that pretty picture. I think it was taken a little while ago, but looks like even though I have 3 kids, I look still quite similar. So, ladies and gentlemen, good morning to all of you joining us here today. It's a pleasure to host you for our first webcast on tenant financial health. And think about financial health. If you look at financial markets, yesterday, S&P up 1.4%, almost at its highest point ever. Today, up a little bit more. We almost forget, sometimes forget, I guess, that we're still in the midst of a severe health crisis. Health crisis with also real economic consequences, also for the real estate sector. And to all of you that are listening in, it's no secret that the COVID-19 pandemic has had severe consequences for commercial real estate, with occupancy rates and rents of retail and office properties being hammered across the country. Now, there's also some upside. Logistics real estate has done exceptionally well. And in the multifamily residential sector, the topic of today's webcast has been another pretty stable factor. Now, to measure the impact of the pandemic on individual commercial real estate assets or portfolios of assets, such as REITs and CMBS pools, you don't need to look further than rent collections. And we've been doing that pretty consistently using different sorts of data. You can directly observe them as an owner, and you can more indirectly observe them as a lender or an investor in REITs and CMBS pool. So for those of you who follow the NMHC, the National Multi-Housing Council rent payment tracker, actually the news has been pretty good, or perhaps even exceptionally strong. So notwithstanding dire predictions thus far, rent collections in about 10 million institutional grade units that the NMHC tracks, those are held by the largest institutional investors across the US. If you look at the data for January, which is the most recent, you see that 88.6% of tenants actually paid their rent. And that's just about 2.5% lower as compared to the same time period last year. Remember, January last year, life was still, I would say, pretty normal, at least in the US. So if you compare that to the month before, December, there's some seasonal influences. We're at about 89.8%. So most headlines really in the Wall Street Journal and the New York Times have been pretty good. They'll echo these positive numbers and optimistic headlines. Now, on the next slide, of course, there's a lot that we don't know, that you don't know, that we don't know. And the last round of stimulus checks was a long time ago. In fact, that was March when the big CARES Act, 2.2 trillion, came into effect. And given that unemployment at 6.7% currently is still twice what it was pre-pandemic, also given the fact that we have 7.3 million people on the sidelines, so they're not even actually applying for jobs, that's about 2.5 million more than what it was pre-pandemic, it kind of makes you wonder whether things are really as good as the headlines say. Measuring that obviously is much more complicated. What's going on under the hood of an apartment building and how our tenants are really coming by. And increasingly, we see some news trickling in that things are really not as great. So beyond the physical health of tenants, which is, of course, let's be honest, is paramount, what's the status of the financial health of tenants? Now, to understand that, you'd have to know a bit about the credit situation of tenants. What's their credit card utilization rate? Are they going to start to max out credit cards? Are they applying for more credit lines? And we have that kind of data. So let me tell you a bit more about credit data and payment behavior. There's something called the credit payment hierarchy. So on the next slide, you see that hierarchy. Now, secured debt is always something that you pay first. Now, for apartment tenants, generally there's no first mortgage on a home. There could be a mortgage on a second home, but generally that's not really the case. So the secured line of credit that they may hold is on a car loan. And generally, when you think about payment prioritization, that's where you make payment first. You don't want to lose your car. So after that, we see retail, credit cards, bank cards, we see unsecured personal loans and student loans. And student loans, we've also seen that pretty strongly in this crisis, health crisis, financial crisis, are typically kind of lowest on the list in terms of payment prioritization. Now, if you were to have information on these credit lines, you could probably say something about the ability of folks to actually make their rent payment. So we actually think that payment behavior on other credit lines can be a leading indicator for rent. So while you as an investor or lender can really predict the future of what's going to happen to rent collections using tenant credit data, we actually think that you can. So today's webinar will feature GeoPhy's data on the credit profile on each tenant and each multifamily asset across the US. And I'll tell you a little bit more about our universe in a second, but it's important that we use data that comes directly from the financial institutions to the credit bureaus, and that's what we then use. So we have information, for example, credit scores, delinquency rates, etc. We aggregate that information at the level of an individual multifamily property. So we don't have information on individual tenants, neither do our clients. We always aggregate it at the level of 1 to 3 Main Street. Now, in today's webinar, we focus on 3 key metrics, and I'll explain to you why these are important. On the right-hand side of the slide, you see all the information that you can get basically from the credit bureaus, whether it's individual credit limits on credit cards, limits, but also current balance on car loans, on mortgages, credit applications. We summarize some of that data, and then we focus on 3 key metrics. The first one is the average credit score in a multifamily property. And we use that because we think that it quite nicely and elegantly captures many indicators of risk of non-payment in the future. And I'll show you, obviously, credit scores in a second, but generally, if credit scores decline with about 30 points, that doubles the risk of non-payment on either one of a consumer's credit line. So there's some systematic interpretation of credit scores, and you and I are both very familiar with it. The second metric that we use is delinquency rates. Well, that's easy to understand. Somebody doesn't make payment. We use 30 days, so fairly low threshold, as kind of the cutoff. So somebody doesn't make payment on either one of their credit lines, and we see that as, hey, that tenant is delinquent. That's relatively easy to compare to actually not making your payment on rents. But of course, actually non-payment behavior delinquency rates are also an input to credit scores. So to some extent, they're almost substitutes. Now, the last metric that we use, you may not have heard of, and that's called a payment holiday. So what we've seen, especially in this pandemic, is that many tenants or many consumers in the US in general have had the ability to defer their payment. So rather than going on a nice trip to Hawaii, they went on a payment holiday. Now, this is not captured in a credit score or in a delinquency rate. Under the CARES Act, basically, the payment holiday was granted to any consumer that applied for it. And we consider a payment holiday a hidden risk. It may be an indication of financial distress. So if you apply as a consumer or as a tenant in a multifamily property for a payment holiday, actually, well, you don't pay off any of your credit card debt. And basically, that might be something that comes back to you once you have to start payment again. So these are the 3 metrics that we use, and we use them at both the level and the 12-month change. So very briefly, what I'll be walking you through today is the current state for each of those 3 credit metrics, as well as the changes from December last year, the year before, December 2019 to December 2020. So we really focus on the financial health of tenants in multifamily properties. And in addition, I'll provide you with some bonus content, the cherry on the pie, in the form of tenant migration metrics. And these metrics are also based on our credit data. A little advance warning. I'm an economist by training, and I'll show you lots of numbers here today. There's not going to be any math or equations or difficult statistics, but feel free to ask questions in the chat We'll address those at the end of the webcast. And of course, all these slides will be made available to you, so you can look back at all the graphs and the numbers at your leisure. Now, to make sure that you're coming out of this webinar with some of the main takeaways, let me give you a short summary of our main observations. And there's a lot of detail on each of these, and I'll go through that in the rest of the webcast. So generally, credit scores across the US first increased actually by about 10 points and have now stabilized. But if you look beyond the average, you see that there's a large variation in what's happening within the multifamily space. 19% of multifamily assets across the US have seen a decline in average credit scores of more than 5 points. I mentioned the hidden risk in payment holiday, and we believe that hidden risk is real. 25% of multifamily assets that we look at have seen an increase of more than 5 points in payment holiday. And that's actually a doubling of what we saw pre-pandemic. Tenant credit data can also be used for granular insights into migration patterns of tenants. And we can actually, beyond kind of the anecdotal story that people are moving out of San Francisco and into Boise, Idaho, we can actually vet that with numbers. We see this clear outflow from gateway cities into the south. And then, beyond Boise, obviously, less dense cities, easier access to outdoor activities, where you can basically, work behind your desk, look at the ski slope, and then at the end of the day, hit it for a couple of runs. I wish I could live that life. So let me tell you a little bit about our multifamily universe, and that's the basis for all of the analysis here today. So we base our analysis on about 23 million units and 326,000 multifamily properties across the US. Now, is that a lot? What's that coverage? If you look at the census ACS numbers from last year, which we will take as the ground truth, in there are about 500,000 multifamily assets. Now, mind you, this is just assets with 5+ units, so we don't look at smaller multifamily or duplexes, triplexes. And in there are about 25 million units. So we cover about 92% of the market by units and about 62% of the market by properties. So what we really miss out on is that space between 5 and 10 units. And the reason for that is that we have a minimum threshold of 10 consumers within a building. Now, people may live together in a building, but it's unlikely that we'll cover a building with 5 or 6 or 7 units. And some of the analysis will actually look at the top 50 MSAs. Within the top 50 MSAs, just for your information, there's 237,000 multifamily properties, about 17 million units. So that's still, a pretty fair chunk or a large chunk of all multifamily assets across the US. All right, let's dive into the financial health of tenants. First, with a state of the nation. It's a little different state of the nation. So this graph shows for all 326,000 multifamily assets that we cover, the average credit score. So that's kind of in green or light blue, if you will, teal. And we started the pandemic at about slightly more than 642, 643. So it's that line in the middle, and it corresponds to the axis on the left. What you saw is that pre-pandemic credit scores were increasing a little bit. That typically happens after the holiday as people start to kind of pay down the debt that they accumulated to buy holiday presents. But actually, with the start of the pandemic, at least kind of the real start in the US, credit scores went up. So kind of totally counterintuitive. But what happened as the CARES Act got underway, people got their stimulus check, people had to cancel their holidays. People actually use less credit, and less credit is reflected in a higher credit score. So credit scores peaked in about October at 651 and have been relatively stable since. So clearly, multifamily tenants from a credit score perspective, have been doing quite well. Same holds actually for delinquency rates. That's the top line, the dark blue line. It corresponds to the axis on the right. What you see the axis on the right is that delinquency rate is actually fairly high. So for all multifamily tenants across the US, about half of them are delinquent. That's 30 days past due on either one or more credit lines. Now, delinquency rates, 46% have come down slightly also during the pandemic. So again, good news. But generally, just so you know, delinquency rates on average were already quite high. Yeah? So pre-pandemic, they were high at 48% as well. So and maybe that comes as a shock to you, but that's basically how people pay their bills. They'll pay them eventually, but not immediately. So then at the bottom, you see the payment holiday. And again, it corresponds to the axis on the right. We've seen a doubling of payment holiday rates albeit from a very low level. We're now at about 6%. So when I talk about payment holiday and I say, well, a 5-point increase, that's almost a doubling of what we saw pre-pandemic. So overall, this slide gives you a pretty warm feeling about the financial situation of tenants and multifamily assets across the US. But of course, if that was it, we would end here. There's much more to this story. So let's take a deeper dive. Of course, when you look at these averages, you look at an average of all tenants across 326,000 properties, multifamily properties in the US. And there's massive variation underneath those good-looking averages. So about a quarter of the properties actually that we observe when we look at the last 12 months saw no large shift in average credit score. So that's kind of between 5, -5, and +5. 58% of multifamily assets actually saw an average increase, sometimes even more than 30%. So again, when you look at the right side of this property, you see people or properties that actually increased in credit score. Now on the left-hand side, that's from a risk perspective, where obviously most of the interest is. You see that 90% of all multifamily assets across the US had a decrease in the average credit score of more than 5 points. 2% of properties had an average drop in credit scores of more than 30 points. And be mindful that these are property averages, right? So for the property average to drop by 30 points, well, either all tenants in a property drop by 30 points, or some tenants in there drop by 50, and some drop by 10, some drop by 20, and that averages out on 30 or more. But that's really bad news for a property. Now, and we don't see a lot of properties there, but still it's almost 2%. Then we look at delinquency rates on the next slide. So basically, you again see this big dispersion in delinquency rates when you look at the 326,000 properties on the US. So 54% of properties, no big change, -5, +5 on delinquency rate, and level, remember, is about 46%. So 5% is about a 10% increase or decrease. But 17% of multifamily assets across the US had a more than 5-point change in payment delinquency. And again, this highlights that underlying dispersion in tenant credit dynamics across the country. Now, the last one here is payment holiday. And again, payment holiday level about 6%, relatively low. 72% of properties across the US, almost 3/4, almost no change in payment holiday. But then look at basically the block on the left. We see that more than 25% of multifamily assets, about a quarter, had 5 or more points change in payment holiday. And again, when I say 5 or more, 5 is already a doubling of what it was pre-pandemic. So pretty large numbers. And a key takeaway here is average is good. Underneath, you see a lot of dispersion. And we'll explore that dispersion really geographically and also then in terms of large and small properties, et cetera. Now, before we do that, and you have this slide still in front of you, as we go from the US to more granular levels, so we'll go to states and CBSAs, et cetera, we focus mostly on the percentage of properties in an area that saw a 5-point change in either credit scores, delinquency rates, or payment holiday. So on the next slide, when I say 5-point or more, it's really the block on the right here that we focus on. All right, so the state of the states. So you got a pretty map here, and it shows you 2 things. It's very colorful, kind of nicely with my background. So you'll see the current average credit score for all multifamily assets within a given state. So let's say Florida, 625. That's the average credit score using our latest data. So that's December 2020. So New York, California, Washington, all relatively high credit scores, probably not overly surprising. And the color of each state reflects what's really happening from a tenant credit perspective. Dark colors imply a larger percentage of properties with a more than 5-point change in a payment holiday. So Nebraska, for example, standing out there, almost half of multifamily assets see a large increase in payment holiday. So, and that 5 points or more. Minnesota, which with an otherwise pretty reasonable credit score, 37% of properties with a large increase. California, 29%. Now, on the flip side, on the more positive side, Arizona has, I say, just 50% of its assets with an increase in payment holiday of 5 points or more. Texas, Georgia are about 17%, Tennessee, 19%. So I mean, there's still issues there, but relatively speaking, it looks a little better. So key takeaway here is that there's large variation in the change of credit metrics across states, with good credit states overall, on average, not necessarily doing so well from a tenant financial health perspective. So let's dive a little deeper because the state is a big metro. Okay, this chart here needs some explanation. This is a bubble chart, zooming in on metros. So last week we published a blog with the most and the least healthy metros from a financial perspective, and that's what you see on this slide. So the bubbles here, each bubble is a metro, and we focus on the top 50 metros here. Otherwise, you would have almost 300 little bubbles and big bubbles here. So the biggest bubble, obviously, in New York is New York. We all knew that. And well, smaller bubbles, you'll see some highlighted LA, etc. So on the x-axis, you see the average credit score, current average credit score for properties in the metro. So New York, actually fairly high average credit score. San Francisco, San Jose, basically even higher average credit scores for all the multifamily assets in their metro. Vegas, on the other hand, Oklahoma, relatively low credit score. On the y-axis, you see where payment holidays are currently highest. So New York and Jacksonville stand out here. Jacksonville a bit more on the left. So clearly, financially healthy tenants sort into gateway cities, and multifamily assets in places like Vegas and Oklahoma have lower credit tenants. No surprise. What really matters is how these metrics have changed since before the pandemic, since December 2019. That's what you see on the next slide. So same setup. So each bubble is a metro, but now the horizontal axis, basically the flat line, corresponds to each metro, where the numbers is the percentage of properties with a more than 5-point drop in the average credit score. And the vertical axis, the y-axis, corresponds to the percentage of properties with a more than 5-point increase in tenants on payment holiday. So as you go further along these axes, that's basically more trouble to the right and more trouble to the top. So recall that a 30-point drop in credit score is quite dramatic, certainly as an average within a property, and that I called Nebraska trouble for almost 50% of properties with a strong increase in payment holiday. So what stands out here? Well, yeah, when you look at large bubbles, San Francisco. So San Francisco has on average a 23% or 23-point drop in average credit score within all of its multifamily assets. And remember, this is an average within a building and an average within that metro. And then we see a 23-point drop. So that's really quite substantial. It's not 30. Indianapolis is worse, and Columbus Ohio is worse. But San Francisco, as one of the largest institutional investing and lending markets in the multifamily space, that's not great news. Smaller markets with high risk, well, I'll just call those out. LA, New York seem to be kind of middle of the pack, which is not necessarily good, right? But relative to San Francisco, LA, and New York, they still had about 15% of properties with a more than 5-point drop in the average credit score, 30% of properties with an increase of 5 points or more in the tenant payment holiday, which, relatively speaking, it's a little better. Next slide, we just summarized it in a nice table. You see the top 10 metros and the top 10 from a credit risk perspective and the bottom 10. So here, being at the bottom, actually for once, is great. So Houston, it's a large market. We count about 4,300 multifamily properties there. Has just 10% of assets with an increase in tenants on payment holiday. With an increase in tenants on payment holiday of more than 5 points. Texas seems to do quite well, at least on a relative basis. Austin, San Antonio in the bottom 10. But what I want to stress here is that in a place like San Antonio, there's still a fifth of multifamily properties with at least a doubling in payment holiday rates. Of course, things can be worse, and it's not confined to certain areas. California, Florida, Midwest, all have metros with a quarter to a third of multifamily assets that see high increases in payment holiday rates. And on top of the list, and again, that's not great news, it's Jacksonville, Florida. 63% of assets actually saw an increase of more than 5 points in tenant payment holidays. So there's a similar list for changing credit scores with different names. It's in the appendix. So once you get a deck, scroll to the appendix and you'll find that similar top 10 and bottom 10 there. Okay, so one more bubble chart, or two more bubble charts on the next two slides. So I want to quickly highlight the difference between large properties and small properties. And the way that we do that is that we look at properties with more or less than 50 units. Now, clearly large properties with hundreds of units are quite different from tiny properties, but we make that split at about 50. So here you see our bubble chart for large assets, defined again as those that have more than 50 units. And what you see here is that the financial health of tenants is somewhat better within larger properties. And you can see that, for example, in New York City, which has now moved substantially kind of to the bottom left, and San Francisco is here. So basically all these bubbles shift a bit more to the bottom left. So there's still a fair percentage of properties with a drop in credit score, with an increase in payment holiday. But it's a little better as compared to on the next slide. So look at what happens here. Maybe go back and forth once to the moderator, large properties and small properties. And here, basically, well, what you see, all bubbles shift to the right, some new names pop up. Austin, which I just called out as, you know, as a metro that does pretty well. When you look at small properties in Austin, there's also pain. So there's really no immunity from a financial health perspective to the effects of the pandemic on the real economy. And I also don't think there's a good vaccine or a vaccination or shot for that. So let's go one level deeper into a metro. New York obviously is the biggest market with more than 50,000 properties, but nobody likes snow anyway. You know, it's like a couple of feet of snow. So let's take a look at LA. And in LA, we cover about 40,000 assets, so multifamily assets. So it's the second largest market in the US from a multifamily perspective. So here's the credit score view on LA. Now you'll see that LA has been cut up into these weird looking shapes. Each of those shapes is a unique neighborhood. So GeoPhy has defined about 94,000 individual neighborhoods across the US, of which 1,500 neighborhoods are in LA alone. So each neighborhood is a combination of one or more census blocks that look and feel similar. And we have an algorithm that clusters together the 9 million census blocks into 94,000 neighborhoods. And we then score and rank each neighborhood based on demographics. So people that live there, income, education, etc. Amenities, so supermarkets, and then bars and restaurants and other places where you can go to. There's housing stock actually, and rent levels, etc. And safety, so crime incidents. So here on the left, we highlight the top 20 neighborhoods in LA by asset count. So Castle Heights, West Hollywood, pretty large neighborhoods from a multifamily account perspective. And on the right-hand side, you see the average credit score in each neighborhood. So you'll see Santa Monica, Mar Vista, Culver City, Pasadena, all the way on the right, Beverly Hills, all neighborhoods with very high credit scores. And those neighborhoods often are rated A or A+, as you can see in the table on the left. But there's also neighborhoods that have a lower neighborhood rating, and generally they have a lower credit score. So again, no surprise, higher credit tenants kind of sort into higher quality neighborhoods. So Westlake South, close to the urban core, neighborhoods in Inglewood, generally, you know, not necessarily bad, but lower quality neighborhoods, fewer amenities, etc. Demographics that are not as favorable, and also lower credit scores. So we kind of know that, right? So that's the sorting of tenants. But what we're interested in here is what happened over the last 12 months. So in the next slide, you actually see the changes in tenant financial health over the last 12 months within LA. Now, the darker color means that there's a bigger change. And what we look at here is a change in credit score. So the darkest color is a drop in credit score, average credit score in a building, in a neighborhood of 25 to 30 points. And again, that's big, right? That's big. That change basically means a doubling of the risk of non-payment on either one or more credit lines. So what's super interesting here is that high quality neighborhoods are not at all insulated from financial distress. Washoe, Montana, which is actually in Santa Monica, top neighborhood in LA. Here where is it? It's kind of sixth A+ neighborhood. About a fifth of the tenants in assets there have seen a substantial drop in credit scores, and 37% of properties have seen a doubling of payment holiday rates. Now compare that to a B+ rated Rampart Village or C+ rated Crenshaw, and actually it makes these otherwise lower quality neighborhoods look pretty good. So even within a metro, there's a lot of variation in the financial health of tenants. And you could argue, if you were to look at our data on individual assets, that variation further persists within a neighborhood. So if you were to look, you know, within Santa Monica or within Wilshire, Montana, at the individual asset level, there's still a lot of variation. All right. As Steve Jobs would say, one more thing. So tenant credit data can also be used to understand whether people are packing up and where they're moving to. After all, when you want your credit card, you want to get it on the right address. So typically when you change address, you also basically change that with your bank and the credit card agency and everybody else that collects credit data on you. And it's more organizations than you think. So importantly, this data covers just tenants in multifamily assets. So we just measure the folks that live in a multifamily asset. And we can monitor outflows very accurately. Inflows can obviously be underestimated if tenants buy a home instead of renting an apartment, or in case they're moving into a vacation Airbnb home or into a single family rental, right? So I would take the outflow numbers very serious and the inflow numbers also serious, but probably they're underestimated. Using the data on individual tenants, again, we aggregate that at any level. So we can aggregate that at the neighborhood level, the state levels, but I won't drag you through this national to neighborhood flow again. I'll just show you two quick tables. Table is already there, which is a signal. I got to hurry up. So the first table here shows tenant migration in the top 10 and bottom 10 metros selected out of the top 50, right? So top 50 metros, the largest in the US, covering 237,000 units and 237,000 properties and 17 million units. And within this, you can see that major, highly urban areas such as San Francisco, San Jose, New York, Chicago, Boston are all in the bottom half. And in this case, the bottom half is bad news, right? So these are the places, for example, San Francisco lost almost 4% of its multifamily tenants. Now, I'll let that sink in for a moment because that's a massive number. We're not just looking at all of San Francisco, including single family rental, including owner occupied homes. We purely look at multifamily tenants, and there 4% actually moved out of San Francisco. Now, even if stock or supply were to stay similar, which is not because we still got buildings coming online, actually this would be pretty staggering news. So in the top 10, we got largely Sunbelt cities, less dense, easier access to outdoors, but also, I would say, interestingly, a place like Cleveland, where we've seen an increase in tenants and multifamily assets by about 2%. And Atlanta really tops there with about 5%. So the next one, that's really kind of the bonus. I took the top 10 and the bottom 10 out of all metropolitan areas. So I will say this includes places with very few multifamily assets. However, there's some interesting observations. So on the downside, Pocatello, north of Salt Lake City, home to Idaho State, might be kind of a nice place, but there's also, not many students that have come back. So about 10% of multifamily tenants might be student homes also. Actually, over the last year have disappeared. Lake Charles, decimated by Hurricane Laura. Hammond was hit by hurricane in 2016. And then we got Columbus, Indiana, which I figured out was the birthplace of Mike Pence. So I'm not sure that's correlated to the fact that it's been shrinking by 8%, but there's generally in these places that have been shrinking. And again, these might be some nondescript places with very few multifamily assets. It's fairly idiosyncratic and probably not because of COVID. Now, if you look at the top, actually, there's definitely some COVID-related increases. So Missoula, Montana has a vacancy rate in the housing market of 0.95%, and it's I looked it up. It looks like a pretty idyllic place to live and sit behind your desk during the day and do fun stuff in the afternoon. I'm not sure the same can be said about Altoona in Pennsylvania. Maybe somebody in the chat can explain to me why that's so interesting, other than its proximity to Penn State, and then you have Pittsburgh and Harrisburg, pretty far away. For the rest in the top 10, you see 4 metros in Texas, top migration list, and yes, Boise, Idaho is there as well. And I looked at Boise, Idaho, and I realized you wouldn't have to invest in GameStop entertainment to get rich. But if you had bought into the housing market of Boise, Idaho, you'd have tripled your investment over the past decade, and that's the most in the nation. So Boise it is. So summarizing, wrapping up our Q4 2020 recap of tenant credit information in the multifamily sector. we actually see that the financial health of tenants looks pretty solid on the surface. And that's what you have seen in headlines over the past couple of months. Increase in credit scores, decrease in delinquency rates over the last year. But there's a big but. Payment holiday is not reflected in either number, and we consider that a hidden risk. More than 25% of multifamily assets across the US have seen an average increase in payment holiday of more than 5 points. And again, that's almost a doubling in payment holiday. Massive geographic dispersion at the metro level, but also within metro areas. So not just LA versus San Francisco versus other places, but also within LA, as I showed. And the South here looks better than most gateway cities. Property size matters for the financial health of tenants. Smaller assets have generally more hidden risk, and the migration patterns can be informed by looking at tenant credit data, especially when it comes to outflow. Georgia, Texas, Sunbelt cities are clear winners. And I call them high alpha cities, not necessarily because of the people that live there, but really for their exposure to market sentiment. High alpha cities, San Francisco, New York, other gateway cities, Chicago, are, or I will say, or continue to be losers, because this is not a trend that was necessarily just set off by the pandemic, but it already started a little bit before that. So with that, thanks a lot for listening in, and I'll turn it over to Chris for some Q&A.
Great, thank you very much, Niels. We've got a few minutes to answer your questions, which have been coming in through the Q&A feature on your screens. So please keep sending them in, and we'll respond by email if we don't have time to answer them all. And so, Niels, the first question that we've got up is, how frequently is the data updated that we're using?
Yeah, so this data is received monthly. We just received the January month-end data, which on the 3rd of February is already on the platform. Clients have access to it. So it's really end of the month, data comes in on that month, and it's in the platform like 3 days later.
Cool. Next question is the data using credit scores from tenant applications? No, so the data doesn't look at tenant credit application. It's really on the tenants that are in a building. So it's current credit scores and data for the occupants. And that's important because the data catches when a tenant health changes after being screened as an applicant. So often a landlord will ask you for your credit score, etc. when you move in. We don't use that. We only use the data once you're in the building. Great. One more question here. Does the data show people migrating to smaller mountain and beach cities? Which I think you answered, but take it away.
Yeah, yes, it does. But again, I think we're really good at tracking what happens to people moving out of buildings. When people move into new cities, they may also move into a single family rental. They may buy a place given where interest rates are. So I think we're underestimating where people are going, but I think the trends directionally are pretty clear.
Okay. We have another question. Do you compare the data to payment collections data?
Yeah, that's something that we have in progress using data from servicers. So hopefully by the next webcast in about 3 months, we'll have that analysis done, and that will give the final and conclusive answer on the correlation, or maybe the causation and the causal effect of the tenant credit situation and subsequent rental payments. We've seen that on a more anecdotal basis in small samples. Now we're going to validate that in a larger sample.
Cool. And I've got one final question here, Niels. What is the meaningful change in credit? What is a meaningful change in credit score?
Yeah, so I highlighted this 30-point change in credit score. So a 30-point change or a drop, let's look at a drop, that implies a doubling of the likelihood of non-payment. And so that's basically how you interpret a 30-point drop, whatever it's from 700 to 670 or from 500 to 470. Now, what's important here is that we look at averages within a property. So if the average credit score in a property goes from 650 to 620, that means that on average, all tenants changed. It might well be that all tenants drop by 30 points, or 50% of the tenants drop by 60 points and 50% drop by 0 points. We have the mean, the median, some information on dispersion, But I will say that an average drop of 30 points in building, well, that's probably bad news for that building because everybody there then goes south pretty quickly.
Okay, excellent. Well, that's the end of our questions. So thanks again, Niels, and thanks everyone for attending. A quick reminder that we will be sending along a recording of the event shortly. And also, GeoPhy has all the data that you've seen today down to a property level, as Niels had indicated. And if you have any remaining questions or comments, please reach out to us. We can be caught at info@geophy.com, and we'll answer those questions just as soon as possible. See you all again in April for the Q1 update. Thanks very much.
Thank you.